Welcome to today's webinar. Thank you for joining us for a discussion about understanding, integrating, and maximizing your Social Security benefits. My name is Justin Smith, and I'm joined today by my colleague, Ryan Monette. We're excited to share a lot of information and strategies pertaining to Social Security with you today. And on our agenda, we're going to begin by discussing some of the mechanics of the Social Security system, how it works. We will then review various claiming strategies and considerations. After that, we'll talk about how you can weave Social Security into an optimized, comprehensive retirement income strategy. We're then going to wrap up with an action plan and your questions. So with that, we're going to get started and hand it over to Ryan to get started and just talk broadly about how the system works.
All right. Thank you, Justin, and thank you to everyone listening in on our webinar today. The Social Security Administration will be celebrating 87 years later this summer, and it really has been one of the most incredible and remarkable programs put in place by our government in that it helps many, many individuals provide an income for themselves, for surviving spouses, and for the disabled. As Justin mentioned earlier, I'm going to start us off by explaining some of the basics about the Social Security system. The system's changed over time as it's faced headwinds in the form of human longevity, earlier retirement, and recessionary periods of time in which payroll tax revenue has decreased. Now we're getting close to a critical point whereby the combined trust fund assets will be exhausted by 2034. And at that point, it's projected that tax revenue will generate 78% of the expected benefit payouts. Because the system is underfunded, we will very likely see changes in our future. There's several ways to get it back to 100% funded. And so we'll talk a little bit about some of those right now. First, we could see an increase in the payroll tax rate. The current tax rate is 6.2% for the employee and 6.2% for the employer, for a total of 12.4%. Increasing this tax would generate more tax revenue. Second, we could see an increase in the earnings limit for which the payroll tax is applied. Currently, the tax rate is 12.4% on the first $147,000 of earned income. Third, we could see a couple ways in which future benefits would be reduced. This would include adjusting the calculation for determining the cost of living adjustment or increasing the full retirement age. At this moment, the COLA is tied to the Consumer Price Index, and the full retirement age for anyone born in 1960 or later is age 67. We see several news headlines throughout the year about Social Security solvency issues. We believe that the system can and will endure, so individuals should not make a hasty decision here. It's important for everybody to plan their Social Security claiming strategy, to base their decision on what we actually know today, and not to speculate or predict the future. So let's talk about Social Security retirement benefits. To be eligible for Social Security, based on your own earnings record, you must have paid into the system for at least 10 years or 40 credits. You earn credits when you pay Social Security taxes. And so in 2022, you must earn at least $6,040 in wages to receive the maximum 4 credits per year. Your Social Security benefit is based on how much you earn. The system includes your highest 35 years of wages for which you paid Social Security taxes. Past wages are indexed for inflation to ensure that future Social Security benefits reflect the rise in the standard of living. To determine an individual's retirement benefit, the Social Security Administration calculates the individual's average index monthly earnings, also known as AIM. AIM is calculated using your past earnings history adjusted for inflation and then divided by the number of months in the years being used in the calculation. As of 2022, this can be calculated as follows. An individual gets credit for 90% of the first $1,024 in monthly earnings. Then 32% of the amount between $1,024 and $6,172 in monthly earnings. And lastly, 15% of the amount over $6,172 in monthly earnings. When you add up those three amounts, you get what's called the primary insurance amount, which is really, if you think about it, your full retirement age amount that you will see on your Social Security statement. It's the amount that you can expect to receive if you claim at your full retirement age. The maximum full retirement age amount in 2022 is $3,345 per month. This is an increase from $3,148 per month last year. The maximum for an individual collecting retirement benefits at the age of 70 is $4,194 per month. And one thing to keep in mind, the estimated average Social Security retirement benefit in 2022 is $1,657 per month. So all the information that I just mentioned above is referencing the individual worker that pays Social Security taxes. However, there are benefits available for spouses, divorced spouses, and survivors as well. A simple way in which benefits can increase or decrease is based on the age in which your individual can claim them. So individuals claiming on their own benefit can claim as early as age 62 or as late as age 70. Claiming earlier will have a permanent reduction in benefit, while claiming after your full retirement age will have a permanent increase in benefit. This chart, this chart shows the decrease in benefit an individual and their spouse would receive if they were to claim at the earliest age possible, age 62. At the bottom of the chart, you can see that an individual born in 1960 or later that has a primary insurance amount of $1,000 per month would receive a 30% decrease in their benefit amount, or only $700 per month, if they claimed at age 62. Further to the right at the bottom of the chart, you'll see a spouse claiming spousal benefits can receive at least 50% of the spouse's primary insurance amount. But if they wait until their full retirement age, that's the age at which they'll get exactly 50%. If they were to claim earlier and claim a spousal benefit, such as age 62, there'd be up to a 35% decrease in their benefit amount, or only $375 per month. There are, of course, some specific rules to keep in mind that will help individuals thinking about how they should handle claiming Social Security retirement benefits. All right, so first, Social Security can be reduced if you claim benefits prior to your full retirement age and you're still working. An individual can earn up to $19,560 before losing $1 for every 2 of earnings in excess of this amount. An individual can earn more the year they turn full retirement age. The earnings amount increases from $19,560 that I mentioned just a minute ago to $51,960 before losing 1 for every $3 of earnings in excess of this amount. After full retirement age, an individual can work and earn as much as they would like without any reduction in Social Security benefits. Second thing to keep in mind, certain individuals may have a reduction in benefits because of past work in which they did not pay into Social Security taxes. This is common for government employees and public education employees. Oftentimes, they do not pay into Social Security, and instead, because of that, they receive a pension through the government entity. When an individual has substantial earnings from work that paid Social Security taxes and from work that did not, this individual may be impacted by what's called the windfall elimination provision. It's basically a provision that puts into place how much you may be able or may be eligible to receive in Social Security benefits while receiving a non-covered pension. Another provision that can impact an individual that might otherwise benefit from spousal benefits or survivor benefits is called the Government Pension Offset Provision, or GPO. So both of these are fairly complex and not a topic of this presentation today, but we can still be available offline to answer specific questions if you think you qualify for one of these provisions. The third thing to keep in mind is that Social Security benefits can be taxable depending on an individual or married couple's tax return. This is based on what is called provisional income, and the point is that Social Security may not be taxed at all, or up to 85% of the benefit amount can be taxable. Social Security does allow individuals to have federal income tax withholding on their benefits, and at this moment, when you sign up, you can choose from a 7%, 10%, 12%, or 22% federal tax withholding. Lastly, an individual should know that they can claim Social Security prior to claiming Medicare, or can claim it after Medicare age. For individuals that claim Social Security before claiming Medicare, they will simply pay for their Medicare premiums via automatic withdrawal from their bank account. Once Social Security is claimed, the Medicare premiums are deducted from their Social Security benefit. Now I'm going to send it back to Justin, who will talk about Social Security claiming strategies.
Thanks for that overview, Ryan. It's really helpful given that there are so many different moving pieces in the system and different complex rules. And I'm glad you emphasized right up front the need to focus on what we can know and what we can control. While changes to the system are likely, we don't think Social Security is going away. So we don't want to make hasty decisions about claiming. And that segues into this next segment, which is talking about various claiming strategies. So as financial planners, we always like to start by thinking about the goal before we start to think about the individual tactics and strategies. So we really want to think about, what are we trying to solve for? What are we trying to accomplish? And as a general rule, we are aiming to maximize the total amount of benefits you will receive over your lifetime. Now, that sounds logical, but there is typically a trade-off, because you need to defer benefits if you're looking to maximize the lifetime value. So it's important to start by taking this kind of long-term mindset and thinking, again, about total lifetime benefits, not just what you could get next year. Expected longevity is also going to play a big role in your claiming decision. I've heard many people say, hey, I might not live that long, so I want to take my benefits now. I'm sure Ryan's heard that countless times as well. And while there might be a few people who unfortunately know they have a very short time horizon, the fact is that most people still have a lot of time ahead of them and can't possibly know how long that time will be. So we've got to work through this problem knowing that there's just going to be uncertainty on longevity. And again, let's focus more on the goals. One of the most common retirement goals people have is to enjoy sustainable cash flow while not worrying that they're going to run out of money. If that sounds like it's one of your goals, we should be much more focused about you living a long time versus living a short time. And your claiming strategy can help you protect against that longer than expected life. Because if you do live a very, very long time and end up depleting your nest egg, it's important that you can have the largest possible Social Security benefit as a safety net to help you manage that longevity risk. On the flip side, if your lifespan does end up being shorter than expected, depleting your nest egg isn't really much of a risk. And lastly, it's important to think too about potential spousal and survivor benefits if you are married. If that's the case, we need to shift the focus from just your lifetime total benefits to the total lifetime benefits as a couple. It's not just a single life expectancy that we're solving for, it's the combined life expectancy. A common approach we see to kind of work around that is when we're looking to maximize lifetime benefits of a couple, we typically like to see a higher earner in the couple defer, whether that's to 67 or to 70, to maximize their own benefit, because that also maximizes the potential amount of spousal and survivor benefits that are going to be available as well. So we started by covering kind of our goals-based approach to thinking through Social Security, which is an important place to start, but it's also worth reviewing this from kind of a statistical angle. And the simplest way we can do that is to think about break-even ages. And keep in mind that according to the IRS and Social Security life expectancy tables, a 62-year-old today is expected to live until about 86. And this chart shows us the cumulative lifetime benefits that 3 different claiming strategies would generate, claiming at 62, 67, and 70. And we can see the various crossover points here. So if you were single and you knew exactly how long you're going to live, this would be the chart you'd be referencing to pick your optimal claiming strategy. Now, of course, we don't know exactly when that day is going to be, but this can help put it in perspective. You may have seen different versions of this online as well. And what we'll typically find is that the age 70 claiming strategy typically wins out after somewhere between age 80 and 81, depending on some of the underlying assumptions you're making. So that means if you do live to that average age of 86 or beyond, deferring until 70 is a pretty clear choice in terms of, again, total lifetime benefits. Now, as I mentioned before, a simple break-even analysis doesn't quite work when you're married or have been married in the past and you have benefits that you're entitled to stemming from that marriage. In those instances, you have multiple benefits and multiple life expectancies to solve for. As a general rule, the break-even ages tend to even get a little bit lower when you're looking at a couple, because there's a higher likelihood that at least one of the spouses will live to the average or beyond. And of course, your claiming decisions will impact other areas of your financial life. And Ryan's going to cover that in our final section on integration. But before we do hand it back to Ryan, I did want to take a moment to address some claiming strategies that have been phased out over the last few years. So in 2015, the Bipartisan Budget Act was passed, and that updated some rules on claiming. These updates were designed to eliminate so-called aggressive claiming strategies and also to help reduce some deficits in the system. Some of these techniques might sound familiar to you. There was a technique called file and suspend. There was another one called the restricted application. But if you were born after 1953, those claiming strategies are no longer an option for you. Social Security also imposed new deemed filing rules, which basically state that if you apply for one benefit, you are deemed to be filing for all available benefits. And effectively, that means you cannot choose one benefit now and then switch over to another later. You are deemed to be filing for all available. One important distinction here is that survivor benefits were not impacted by these deemed filing rules. So there are still a number of complex yet advantageous claiming strategies if you are entitled to survivor benefits or ex-survivor benefits. So please send us a note if you're in that situation. We have a whole suite of educational content available that's focused just on those survivor benefits. So with that, we'll hand it back to Ryan to talk about putting this all together and creating an integrated plan.
All right, thanks, Justin. I remember, been at Savant for a long time, and I remember helping a lot of folks with those file suspended applications and file restricted applications, and that was a fun process to go through. And it was too bad that they did eliminate that because it took away a lot of the fun strategies that you and I could work through with our clients in order to maximize benefits over their lifetime. So yeah, I'm going to talk a little bit about integrating Social Security. So, the important thing is here at Savant, we really believe that integrating Social Security benefits into your retirement income strategy is an important step in your financial plan. In a sense, Social Security is like think of it like as a big bond, and that it will produce consistent, known fixed income, and it can be an important source of income for individuals' ability to meet their future spending goals. Working through a Social Security claiming strategy is an important part of an individual's or a married couple's financial plan. So what we like to do here at Savant is use a comprehensive tool that incorporates your spending goals with your resources. And we find that that's crucial for helping you choose a claiming strategy that will help you maximize the funding of your retirement goals. A retirement planning tool like the one we use, Money Guide Pro, provides a big picture overview of the various Social Security claiming strategies available and the impact on your financial plan. You will see on the slide that the tool that we use to help in the Social Security decision-making process. In this illustration, we show several claiming strategies, such as waiting until age 70, which you can find on the far left-hand side, claiming earlier than that. In this example, we're showing individuals age 64 and 63 claiming, and then claiming at full retirement age, which is also in the middle section there. Because this tool is very comprehensive, it looks at all of the inputs and assumptions to help determine the most optimal strategy based on the probability of meeting all of a client's financial goals. So what you'll see on that slide there and what's highlighted is that particular strategy, claiming at 70, provided the most long-term benefit based on all the other inputs, such as spending, how long you're going to live, inflation, et cetera. But it also gives the ability for individuals to make other decisions, such as claiming earlier or at full retirement age. So we get to kind of put them all on the screen for folks and show them exactly what the kind of the long-term benefits will be. When building out a retirement income strategy, we like to look at all sources that are available to meet spending needs. This can include retirement accounts and brokerage accounts. We can also include cash assets or other sources of fixed income, like a pension or income from real estate. Accounting for all current and future assets and income can help us design a cash flow strategy that allows us to model various Social Security claiming strategies. Claiming Social Security benefits early will allow for investable assets to continue to grow. The income from Social Security will put less demand on your investment assets. This can be beneficial when an individual believes their assets can grow at a faster pace than the increases earned when delaying Social Security, or for someone that has a shortened life expectancy or would prefer to make sure they leave a legacy for loved ones. Claiming Social Security later may allow for strategic planning opportunities, though, such as Roth conversions and capital gain harvesting. Because Social Security can be taxable, delaying this income can allow for more room to make Roth conversions or generate capital gains. On the slide that you're seeing right now, you'll see a chart that represents an individual's total income over time and where that income is coming from. This allows us to identify opportunities for when to start different sources of income, when to start or stop distributions from investment accounts, and when it may be best, based on the tax code, to initiate Roth conversions, generate capital gains, or some other type of financial planning opportunity. So basically, designing an integrated retirement income strategy is a necessary step in the financial planning process, and Social Security is really at the heart of the analysis. I'm going to send it back to Justin to take us home now.
Hey, thanks, Ryan. And thanks for emphasizing that coordinated approach. There's a lot of value that can be generated when we take that comprehensive perspective and put all the different pieces together. So we've armed you with a lot of information. We've intentionally gone through things very quickly today because we have a lot of folks on the call today. We've got a lot of questions coming in already. So again, there are bound to be questions. We welcome those. So you can start populating those into the Q&A and chat sections. And as those are coming in, I want to set you up with an action plan because again, this information needs to be put into action for it to benefit you. So what should you do next? If you haven't already, you should log into your SSA.gov account and review your benefit report. You'll notice that they've formatted that report in the last couple of years. You will no longer see every single year with every single year's earnings listed. It's more of a consolidated 2-page type report that's a little bit more user-friendly. And go into that report and just review the most recent years and make sure you're getting credit for all the money you've paid into the system. Specifically, if you are self-employed or maybe had a non-W-2 type earnings scenario, you want to make sure if you were paying into the system that those earnings got reported and therefore are adding to your benefits. The next step then is to take an inventory of the ancillary benefits that may be available to you. That could be spousal benefits, ex-spousal benefits, survivor benefits, or ex-survivor benefits. Then analyze your different options, look through break-even ages, and determine which strategies will be able to help you maximize total lifetime benefits. And then finally, think about integrating Social Security into your comprehensive retirement strategy. This is not a decision you should be making in a vacuum. You want to be making sure you're weaving in your other income sources, your investments, the tax impact, and the overall sustainability and ability to meet your goals is what's most important. So I see we got a lot of questions coming in, and we're going to go over to the chat and next cover your questions. So Ryan, do you want to kick us off with some of those questions?
Yeah, thanks, Justin. One of the questions that came in that actually you and I have probably gotten this question quite a few times over. So I thought we'd start here. This question in particular asks, what if I do take benefits before my full retirement age and I'm still working, so I still have earned income. And in this instance, what'll happen if I go over like that $19,650 limit, between age 62 and my full retirement age, and you lose $1 for every 2 that you earn in excess of that 19,000, what happens? And so, here's kind of the quick and dirty answer to that is every year that you continue to pay into Social Security and pay those taxes, what Social Security is doing behind the scenes is recalculating your benefit amount for every month going forward. And so you claimed it early, maybe you actually don't get all of it because your earnings went over that limit. What they'll do is they'll add those wages to your 35 highest years, and they'll recalculate your benefit for the future. Now, because you claimed early, there's still some reductions there, but your benefit in the future should actually increase because you continue to pay into Social Security, and it probably takes over for one of the earlier 35 years, maybe when you're 18, with your first job and you made very little income, it probably takes precedent over that year, and so your benefit should go up. But because you did claim it early, there's still that reduction. That was one of the questions. Hopefully that was answered sufficiently. The next question, let's see. The next question, Justin, it has to do with what are some of the strategies for spousal benefits. And I think what you alluded to earlier is most of those strategies or those important strategies have gone away with now because of the 2015 act that Congress put together. But what are maybe some of the really what are some of the things that we would look at when helping someone identify, what kind of spousal benefit they should claim, or what strategy they should take for a spousal option?
Yeah, it's a great question. And again, it's going to be very, specific to the individual couple, right? Because we could have one couple that has two max earners that both have a maximum benefit. In that case, the spousal benefit or the survivor benefit isn't that important. But what we do find in situations where we have one primary breadwinner and the other spouse with a small or non-existent retirement benefit, that is when our focus gets to be on maximizing the total lifetime value and survivor benefit value of that highest possible benefit. So that's always a good thing to do in a married couple. Say, where's your benefit at? Where's your benefit at? And if there's a significant difference, also if there's a significant difference in age, we want to think about what's the best way to maximize spousal benefits or also survivor benefits. And then Ryan, one thing also back on our question related to the earnings test, I think one thing that I went back and reread the question, I think part of the question was, is that early filing penalty locked in? So as we reviewed right up front, if you file early, you have a 30% reduction that's kind of locked in. If you do hit the earnings test and Social Security withholds your wages, it's effectively like you did not claim early. So there's another calculation going on in the background that's readjusting. So for instance, if you claimed at 62, thinking that you weren't going to work again, and then all of a sudden got a job paying high enough wages to completely wipe out your benefit, and then you went back to reclaim at 67, there's adjustments in the background that happen that will effectively wipe out that earnings or the early filing penalty of 30%. So you wouldn't necessarily be worse off, but it's typically a hassle and it's not worth it if you know you're going to be earning well above and beyond that earnings test threshold, which again, it starts at 19,000. Most of the time benefits are completely phased out, sometime between 60 and 80,000 of wages. If you know you're going to be well above that, it's not even worth bothering to file because it's probably going to set you back a little bit.
Well, that brings up a good point, Justin. I mean, it also ties into what if I'm 62, I think I'm going to retire, and so I go ahead and file for Social Security benefits, but then realize, well, my employer wants me to come back, and they make it really attractive for me to do that. There's a window of time in which you can, stop those benefits without it really impacting your record. Is that correct?
Yes, exactly.
And then there's. Sorry, I was also going to say, and then there's also what's called voluntarily suspending benefits, and that usually takes place after your full retirement age. So you can claim early, and let's just say life changes, you realize you want a bigger dollar amount from Social Security for the rest of your life. After your full retirement age, you can do what's called a voluntary suspension, where you can stop the benefits. Social Security will stop sending those to you. You can actually start to earn those delayed retirement credits to build that benefit back up.
Exactly. And Ryan, another great question on the earnings. So we talked about, your benefit is based on your highest 35 years of earnings. And the question was, if you have lower than average earnings in the last, say couple years of employment, will that lower your benefit? And it will not, because that 35, it's the highest 35 years of earnings. So if they happen to be on the low end, they're not going to make it into the equation. What usually happens is they're going to bump out something that was smaller, because 35 years is a long time, and there might be a couple little gaps or holes in that earnings record. So it's not going to hurt you. Paying more into the system, I don't know that it could ever hurt you. In that situation we just talked about, 2 more years below average is not going to hurt you. It might not help all that much, but it's not going to hurt you. And then, Ryan, here's a good one. What percentage does a surviving spouse get of the primary benefit holder's benefit?
Okay, yeah, that's a good question. You see that one come in occasionally, and so the answer can differ because it depends on essentially a couple things. When did the primary insurance or the primary worker claim? How old are you, or how long were you married for? There's a lot that can go into this, but essentially most of the time what we find is that a survivor typically takes over 100% of the benefit amount that the deceased individual was receiving at that time. So just to kind of put math to, or pen to paper here, let's just say that, primary worker was earning $2,000 per month and spouse was earning $500 per month, and the primary worker passes away. What will the spouse receive? Could be up to that $2,000 per month. Now, it's not going to be the total of both. It won't be the 2,500 moving forward still, but it'll be that 2,000. So typically 100% of the survivor, the survivor receives 100% of the benefit, the larger of the two. And another question that popped up, and this is a good question too. We talked about what are those reductions, and it kind of through 35%, 30%, 25%. But keep in mind that those reductions are actually based on a per month. So you can claim at 62 in 3 months or 62 in 5 months. It doesn't have to be right at 62, right at 63. And the longer that you wait, there is a benefit for doing so. And in case somebody was wondering what those percentages are, basically it's 0.5% for the first 36 months before full retirement age. So said differently, if you did all 36 months, that would be 20% of a reduction. So it's 0.5% for the first 36 months, and then 0.5% for each additional month beyond 36 months. So that's the calculation. And so if you happen to claim not exactly on your birthday, that's how you would just run those numbers, and that you'd be able to figure out what your reduction was that way.
Thanks, Ryan. Hey, we had another question on taxability. So it's worth cycling back to that, because it's not about how much you receive, it's about how much you keep after taxes. So as we mentioned, there's this taxability range between 0 and 85%. The good news is that even if you're at the very top end of the income range, 15% is still tax-free. Now, that very well could change with some of the changes to the system, but let's talk further about how people move through that range. So if Social Security is your only source of income, it's going to be 0% taxable. And there's actually a floor on other income. Depending on if you're married or single, it's in the 20 to 30,000 range. So up until that point, when you have 20 or 30,000 of other income plus Social Security, it's going to be 0% taxable. And then as you add more and more taxable income, more and more of those benefits become taxable up until the point when 85% is taxable. And an important, circling this back to our kind of integrated approach with a tax focus, is that sliding scale can create some unforeseen tax consequences. Because let's say you take $1 extra out of your IRA, and you know that you're in the 12% or 22% tax bracket. You think it might cost you 22%, but that $1 you took out of your IRA also means $1 more of Social Security becomes taxable, which can create this kind of cascading effect. And it's important to be thinking through this kind of dynamic sliding scale. So it's really tricky. It's hard to kind of show on paper here, but it's something to be aware of. That taxability range creates a lot of tax headaches for folks.
There was
Ryan, you see any more you want to grab?
Yeah, there was one other question on there that that talked a little bit about spousal benefits. In this particular situation, the question has to do with something that's no longer available, really a kind of a file and suspend or file restricted application. But the question was essentially, my spouse is younger and a high wage earner, and when I claim, can my spouse, claim spousal benefits and then cancel those and start, benefits on her own record? And essentially, this goes back to that deemed filing. And so at that point, if your spouse was going to claim a benefit, it would be based on her record, earnings record at that time, or yours, and she would either get her own amount or a portion of your record, your benefit amount, just based on what is larger. And so there, unfortunately, that whole file and suspend rule went away, and can no longer take advantage of those strategies.
Hey, Ryan, related to deemed filing, there's another question that came in about survivor benefits. And can I claim a survivor benefit early and then switch to my own later? And as I mentioned, survivor benefits are the one exception to the deemed filing rules. So in that instance, yes, if you have a survivor benefit or an ex-survivor benefit, you are able to do what we call a switching strategy. You can claim one first and then switch to the other later. Now, which one you take first, which one you take second, depends on your own personal circumstances, but it's something to be aware of because there can be a lot of additional benefits you can receive from the system by doing that switching strategy.
Yeah. Let's see, there's also a question that just popped in a little bit about Social Security disability insurance and disability income. And essentially, it kind of sounds like in this example that maybe somebody is receiving maybe disability through work, which is sometimes common, a benefit that employers will offer. And typically that insurance will run through age 65, I believe. And so the question is what kind of happens in that instance? And what I've seen in the past, not with a ton of history behind my belt on this, but what I've seen is that in these examples, an individual might be getting disability through their employer until about age 65. And then from there, their retirement benefits kick in. And it's really not like Social Security disability benefit. It's their actual retirement benefit that they're owed at that time. I'm not sure if those rules, Justin, have increased, from 65 to 67 now, just as full retirement age has gone up, but that was one instance that I recall in the past.
Okay.
Yep.
I'm going to go through a couple more questions. We've got a lot, and again, really appreciate everybody's input on this. We love having a collaborative discussion. We're not going to be able to cover all the questions just because of the volume, and also some of these are personal. We want to protect your privacy, and we want to keep this focused on kind of broad educational topics. But we do encourage you, when we wrap up this presentation in a couple minutes, there will be a survey, and there will be a chance for you to reach out to us and connect with us if you have further questions, if you want to talk to an advisor about your own personal circumstances. So a lot of these questions that I'm seeing here, fantastic questions. People are asking the right ones, but we're going to need to go more in depth. Again, Ryan and I want to be able to bring an integrated plan and strategy together, and it's not something we can always do in 30 seconds off the cuff. But again, we really hope you guys follow up with us so we can help you out with that. One question was, lower earning spouse, can they start their benefit earlier and then switch to a spousal benefit later once the high income earning spouse is finished deferring? Yes, you can. And that is actually a fairly common, now that the more advanced strategies are gone, that is one of the common kind of staggered claiming strategies we see. Now, if you claim early, you will still get dinged with that early filing penalty, and that will impact potentially your spousal benefit as well. But again, it's about looking at the total lifetime income and benefits to the household. And sometimes that can make a lot of sense. It can also help bridge the gap with cash flow while you're waiting for that higher earner to hit 70.
Justin, there's a question about the government pension offset provision as it might relate to a spouse. And what's that, what's that calculation essentially? So I just thought I'd take a second real quick to answer that. Maybe this individual that asked the question can kind of, translate that into their unique situation. But basically, when it comes to the government pension offset provision, what you do there is you look at the pension amount, you take 2/3 of that, okay, 2/3 of that dollar amount, and then you subtract the monthly benefit that survivor would receive, that survivor benefit. And essentially, if it's zero, then there would be nothing that survivor would receive. If there's some dollar remainder left over, then that's the approximate amount that they would receive as a survivor benefit.
Yeah, and then expanding on that with the WEP, the windfall elimination provision, that will not take a benefit, typically will not take a benefit down to zero, but it will just have a fixed dollar amount that gets taken off the top. It can be, I think the maximum this year is just over $500 that can be subtracted from your kind of top line benefit from the WEP. Had a couple other rapid fire ones we'll do here. If a higher earner retires before 70 and then they defer, will that reduce their benefit? No, as long as, again, with a caveat that if they had 35 years, they've got those 35 years filled. Retiring and claiming benefits are not necessarily going to be connected as long as they have that filled in. We had another question on survivor benefits. How long do they last, and are they reduced by children? So that's actually a great question. Again, there are so many, we could probably do 5 more webinars on some of these complex side topics. Family benefits are one of those things. So children under the age of 16 are entitled to survivor benefits, and there's also caretaker benefits that are available. When you have multiple family members claiming on one decedent, something called the family max comes into play. Again, it's a complex thing, but children and the spouse and or caretaker could all potentially be eligible for benefits, but there might be some kind of overall family cap. And in terms of how long do survivor benefits last, they last for the lifetime of the surviving spouse.
There's another question here. Is there a disadvantage to taking a spousal benefit? And again, this is probably pretty unique to the individual asking the question, but I would look at that and say, well, if this is somebody that doesn't have their own earnings history or it's very small, then typically you're probably going to get the spousal benefit, and you receive that as early as the spouse that had claimed for benefits. Said differently, you can't start a spousal benefit before your spouse actually claims themselves. But also I would say, is there a disadvantage? I'd say if you were still working and earning money and paying taxes to Social Security, and that might boost your own benefit up, then there could be some advantage to continue to do that, because you might find that your own benefit would increase above what a spousal benefit is.
Yeah. Hey, Ryan, we got a couple more here. Is money taken out of a retirement account or pension income, does that count towards the earnings test? No, it does not. The earnings test, that was a great clarification, is only for earned income. So that's typically W-2 income that you are earning from employment or self-employment earnings. So self-employment earnings can come in the form of a 1099, but those are the only things that count towards the earning test. Dividends, interest, rental income, pensions, retirement account distributions do not impact that earnings test. And had another survivor benefit question. Can the survivor delay, or do they need to claim at the time of death? The surviving spouse has a variety of different options. They can wait all the way until 70 to claim it, but typically a surviving spouse benefit does not increase after 67. So it typically doesn't make sense to wait anytime after 67 to claim one of those. But again, that there can be these switching strategies, and there might be a different thing to consider there. So again, a good question, but the answer is more complex than we can fully tackle here.
Justin, not sure how we're doing on timing, but I do find another one. This specific question just wants to know, what are the factors that I should be considering when thinking about when I should claim Social Security? And we hinted at some of this during the presentation, but the things that pop into my head first are, what are your age, and are you married, and what is your spouse's age? What is the earnings record? So what should you get from Social Security, each of you at your full retirement age, or if it's reduced, or not. So having the Social Security statement is really important, right? Logging in online, as you showed the instructions for that, Justin. But I also take into account, pensions and other sources of income. Is one spouse still working? Is one not working? What are the investment accounts, and what are the size of those investment accounts? Is there a significant age difference between you and your spouse? What is longevity and health concerns? Do you family history tell you that you're going to pass away sooner, but maybe not necessarily. If you're in good health, that might not matter. So, and then lastly, I think it's really kind of trying to tie back to most important goals. I kind of like to call it a statement of financial purpose. What is really important to you as an individual or as a couple, and running, using a comprehensive, system like we have in order to identify, putting all those assumptions in and really trying to figure out, are we going to hit those most important goals? And sometimes, potential strategy that I see and, has become pretty common is, maybe the lower earning spouse claims early, just to get the income started, to get some benefit going, to help maybe not put so much stress on the investment accounts. And then maybe the higher earner, waits as long as they can. And if the markets are doing well and they're producing income from other sources, maybe wait till 70. In a way, I kind of look at it as an insurance policy, in that, if that one spouse happens to to outlive the other and they have the larger amount, well, they'll just continue at that large amount. But if the the larger earner, if they pass away, then it becomes the survivor benefit for the spouse that took it early.
Hey, great. Ryan, we're going to have to wrap it up shortly here, but I wanted to kind of close with one last question, which I thought was fitting, which is, when do you recommend starting the planning process? And I think when we're thinking specifically about Social Security, 55, late 50s is a great time to start thinking about this. You want to give yourself some lead time, maybe put some other pieces in place. And it's always just good to know kind of what options are out there. And then we can start integrating with all the other important financial pieces of the puzzle, your retirement timeline, all of that. So in general, Ryan's going to agree with me. There's never a bad time to get started with financial planning. The best time was yesterday. The next best time is today. So when we conclude this webinar, there is going to be a survey that pops up. That's going to be a great place. Again, if we didn't cover your question, if you want to set up a time to talk with an advisor, use that survey to kind of connect with us, and we'll be sure to put you in contact with me, Ryan, or another one of the local Savant advisors near you that can help you kind of work through some of these questions. Again, we love doing this work. This is so important. We want to make sure everybody gets the maximum of value out of this very valuable benefit they possibly can. And again, make sure that it's going towards your overall goals and building you towards your ideal financial future. So with that, I'm going to wrap it up, and thank you everyone so much for your time and attention and attendance today. I've never seen so many great questions and comments in a webinar. So this has been a great time. Hope to do it again soon. Thanks all.
Thank you.